Okay, hello. How are you guys? Today we are going to share with you a wonderful topic, which is corporate finance. In corporate finance, today we will discuss about uh, uh, MPV, which is time value of money. Value of money, in short, we will see how the money for today is equal the money in futures. Is this same? Is this different? And so on. So in this topic, there is key concept. We will going to handle this. To be clear that we were going to discuss this, be able to compute the future value of investment made today's, be able to compute the present value of cash to be received at some future date, be able to compute the return on the investment, be able to compute the number of period that equals and present value and future value given an interest rate. And last but not least, be able to use the financial calculator to solve time value of money problems. And I'm going to advise you guys here, you need to find financial calculators to, to see how we are going to solve that. Okay, we will handle three here in outline, future value and compounding. We see the interest rate in compounding interest rate and simple interest rate. Also, we are going to see the present values and how we are going to discount that values, and more about present value and future value, inshallah, you'll see. The most fundamental concept for finance is that ways that how you're going to fund and finance your projects or your companies. As we can know previously, can use loan or use equity or use debt and so on. Time value of money allow to comparison of cash flow from different periods, for example, today and futures. If you spend $1 for today, you need to see how this you can generate money in futures. And dollar for today is not equal that dollar for future, because if you invest this dollar for today, you can generate a lot of money and get that in futures. Can be used to assess effects of decision on long-term cash flow. So yes, this you will decide whether to invest or not, because in terms of how you're going to benefit from this. Enable financial managers to evaluate cash flows that occur at different times and link them to the goal of market value maximization. As we know, the managers all time they just focus for maximization their profit, so that this kind of model or kind of lesson or helping them to evaluate how they can manage this and generate a lot of money in futures. So they count the value of today's or present values equal in futures. So is this compounding, or they use simple interest rate, or how they going to use that? The future values, in short, is this amount that which investment will grow after earning invest later, or this is the money is come later. So that after you invest your money and get the present values, you will invest this money and you will get all your monies, principal values and interest rate. And the present value, the value that you are going to pay for today's in order to generate cash flow in future values. So that the money is called earlier money. So it's money is called for to pay for today's. The interest rate or exchange rate between the earlier money and later money. So if you want to get money for today, you need to pay interest rate. The interest rate, that is a percentage for this amount. For example, if you need to pay $1,000, so you need to charge like 10 percent. That means you need in future for 1 year, almost you need to pay like 1,100. The interest rate, there is a lot of names, like said exchange rate or discount rate or cost of capital or opportunity cost of capital, required rate of return. All this the name of the interest rate, but the different name is it is include different description or something on. So this is the equation that if we need to calculate future value, it is said that present value multiplied by 1 plus R. R here is required rate of return or discount rate or exchange rate as we discussed before. And this rises to the T. T is time. So that maybe 1 year, 2 years, 1 month, 3 months, and so on. And this is depends on the project and how they want to invest in this project. Is this annually or monthly or and so on? So that this is the equation for future value. We will see how we can calculate that. Okay, see here, guys. They say suppose that you invest 1,000 for 1 year at 5 required rate of return per year. Be careful here. Say it's per year. Sometimes they say per month. So that you need to see exactly when they said per year or per month or per we can see per or semi-annually or per days. You need to be careful of this. They ask what is the future value in 1 year. So the interest rate here is 1 divided by or multiplied by this amount. This amount multiplied by this amount, we need to see how much the interest rate we gonna benefit from this. It is around $50. So that the value in 1 year's principal plus interest rate is 1,000 plus $50. It equal $1,050. You can also use same equation to get same number. Okay, it will be 1,000 multiplied by 1 plus the percentage of required rate of return. Will get same amount. And they said that suppose you leave the money in for another years, how much you will have 2 years from now. So you can use like future value future value 1000 multiplied by 1 plus R, which is 1, which is 5% rise to the 2. Okay, the power 2. So that, or you can use this one, 1000 multiplied by 1.5 multiplied by 1.5, because this is 1 years and 2 years. Okay, so that you will go and find this one, and the amount that you will gain benefit from this is 102.5. So this the amount that you are going to collect at the end of 2 years. So as you can see, here is 5, and the second years we will got like 5 2.5, right? 5 2.5, that means for interest rate itself we charge it. So this amount here we will get interest rate in interest rate. So this how the compound interest rate work, and you can calculate clearly future value and by this equation. Also, there is difference between simple interest rate and compound interest rate. Simple interest rate, it is for 1 year or less than that. You will use a simple interest rate. But usually in before 2 years and above, we will use what is called compound interest rate. So compound interest rate, it will be yearly or monthly or so on, but you need to know how to combine that. They said consider the previous example, future value with simple interest rate is 1000 plus 50 plus 50. You will get 1100. But in compounding, when they use compounding interest rate, we will get 102.5. So 2.5 years, this is compounding, because for interest rate that we generated for 1005, okay, for this 5 also we 1005 $5. In this $5 also we got benefit for the second years. We use this for second years to generate a lot of amount. So that's why we got 2.5. I hope this is clear. Okay. So this the present values and diagram. In first, this amount is discounted, so that if we need to use the calculator, we need to put this is a negative, in order to find the compounding or discounting future value. So this here we use a lot of, for example, more than for what is called interest rate, so that we find when there is zero, there is the amount is look like stable. There's no a lot of benefit. When we increase the interest rate, also the benefit increase. So that means the interest rate, when they goes up, the benefit also going up. And also we need to see clearly here also the interest rate and the price or the present value is opposite. When the interest rate goes up, present value goes down. When the present goes up, the interest rate will goes down. Uh, Here we can use the calculator. There is a lot of calculator that we need to use. For example, there is HB 10B, and also there is financial calculator that generated by Casios. So we can use that also. So just you need to key in your calculator for this example that said suppose you invest the 1000 for the previous example for 5 years, how much you have? So that same that example you used before. The n is, or sometimes you find this t. T is time or n is time also. 5 and 1 divided by y, or I divided by y. This in the calculators, this is called, this is a percentage of interest rate or R. Okay. So here's this the 1 years, that means annually. Okay, you need to put this annually, and this you need to put this in the place of calculators that this as a present value, so that after that we need to press for future value so that you will get this amount. Okay, you can try that and see. The effective of compounding is small for a small number of periods, but is increased as the number of periods increase. For example, it's 1 years, it will be few, but for 2 years, 3 years, 5 years, it will increase as the number of period increase. Okay, so you can, if you want to see that, just key this 1 years, make it 2 years, 3 years, and 4 years, and you can see the difference. So when you use this, you will find the difference. Also, we need to see another example in order to be clear, that says suppose you had relative deposit 10 at 5.5%. This is interest rate, and 200 is $200 or 200 years ago. How much would the investment be worth today? Be careful, they say today's. Today's, that means the present value or now. You need to be clear for that. When they say today or say uh, now or present, that means we need is here. So in here it is the number of years, and 1.5, this is interest rate, and for 1 years, that means annually. They said annually. Uh, if if they don't say monthly or semi-annually or yearly or sorry, daily, that means is yearly. Need to be careful here. If they don't mention anything, that means it's yearly. But if they want monthly or semi-annually or something on, they will mention. So if we key this in calculators, we will get this amount. Or you can use the equation that they say future value, as we showed before, is equal present value uh, divided by 1. Sorry. So is this. So future value is present value as a value PV multiplied with 1 plus R is or T or N. So if you use this, you will get this amount. So the present value here is how much? Is $10 or $10,000, and R here is 5.5, and T here is 200, so that you will get this amount. If you want to use your calculator or you use manual. They said, what is effect of compounding the simple interest rate? You will say 10 plus 2. This is present value. This is the years, sorry, multiplied by 10, which is present value, multiplied by 0.55. So that we will get 120. Compounding added, it is this number for uh, for 4,047,069.84. This is amount that if you use compounding interest rate. Okay, they say that also there's another example. They said if the future, if the suppose that the compound expected to increase unit sale for medical golf by 15 per years, so that the payment is yearly for the next 5 years. If you sell 3 million medical golf gloves in the current years, how many medical gloves do you expect it to sell in 5 years? So this is clear example. The N is 5 and R is 15, and the payment is yearly. That means one, we need to set up this in our calculators, and the PV or present value is 3 million. So the future value, it will be 6 million 30 34,072 units. Okay. They said, how much do you have to invest today to have some amount in futures? Okay. The future is equal present value plus 1 present value multiplied by 1 plus r of the power of t. So this how to calculate future value. If we need to invest for today, that means present value, we need to rearrange and to solve the equation to see how we can do that. So here we just do for future value, we divided this by PV. Okay, PV multiplied by 1 plus R power T. That means this will see PV. So we need to get PV. So that 1 plus R power T is equal PV. So this will be this like divided. Be careful, this is divided. This is divided. So this is the equation for PV. Same, if we need to calculate present value, we need to discount this. Need to discount it back from the futures, example from 5 years to years or for today. We see how much that we can found money for today's or pay money for today's. For example, if we need 4 or 5,000 in futures, we need to pay this. How much we need to get today? Maybe 4,000 or something like this. So that we will get this amount and we will pay this amount later because we will invest years and generate a lot of money so that we can be able to pay more. This I discussed this before. Same, when the amount of interest rates goes up, the present value will goes down. So this is the example that we can see clearly and how to calculate present value. Suppose that you need to invest 1,000 or $10,000 in 1 year for the down payment, so that you need cash down of new car. If you can earn 7% annually, see, annually or yearly or 1 year or so and so on, that means is for years. How much do you need to invest today? When they say today, that means is present value. So that we need to use the present value equation, which is this equation. Okay, present value is future value divided by 1 plus R power T. Okay, so 10,000 divided by 1.7 equal power of T is what you want is 1 years will be 9,300 45.79. If we need to calculate this in calculators, we need to key this 1 years, and this 7 is the percentage of interest rate, and 10,000 this is future value. Then just press TV, you will get this amount. So if you ask why this amount is all negative, the negative amount, that means is indicate for present values or discount present values that we need to get for this. Okay, and remember that this amount should be negative when you need to calculate present values, so that the calculator, if you put positive, the calculator will not going to detect this, and they will give another amount, not correct amount. Also, there is another example. If n is equals n, this is year, as we said before, is equals 17, and payment is yearly, and equal the years is 8, and the future value is equal $150,000. So we need to use calculators, and we need to use the equation, same equation that we used before, in which is present value is equal future value divided by 1 plus r, equal 4 of t. So t here is the years, as we said before, and we can use also the calculators, which you press n for t, some calculators, that is years 17, and I divided by y, that means is yearly, and equal 8 years here, and the future value is 105,000, so that we can get this amount for today's. For today's, we need to get for like 40,540.34 to invest this, or to use for fund, or to use for anything. But we need in future for 8 years, we need to get 105,000. We need to pay this in future. Okay, thank you so much. I hope you enjoy this, and we will see you in next lesson. And I hope that you also press and subscribe in the bottom areas in YouTube, so that you can encourage us to give you more. Also, we will going to add more lessons about this. If you are interested, please follow us. Thank you so much.